Welcome to the INET webinar. Today, I think we have many things to celebrate. Thinking back to my undergraduate days at MIT, Lance Taylor was one of the professors whose energy, influenced us all, as was Tom Ferguson in political science. And today we're here to celebrate a book, the title of which is Macroeconomic Inequality from Reagan to Trump, which was written by Lance Taylor and Özlem Ömer. It's also the first book, the inaugural title, in the Cambridge University Press INET book series. We're joined today, as I mentioned, by Lance and Özlem, our authors, panelists, discussants, Duncan Foley from the New School, and Malaney from INET in the West Coast. And the moderator will be Tom Ferguson. Tom, let me turn things over to you, but please feel free. You're a central curator of our Cambridge INET book series, so maybe sharing with the audience today some of your perspective on that series and its promise would be a good place to start.
All right, thanks, Rob. I just want to say a few words because I think the panel is the thing today. But basically, the idea for this series arose out of a set of experiences. I'll go back to one in particular. Peter Temin and I, yet another MIT person, and I should add that Duncan also taught for a long time at MIT. But Peter and I were doing a joint seminar, I think in Toronto, and at an INET plenary. And at that point, the problem before everybody's brain was effective demand, because this was back when, not only the European Central Bank, but vast numbers of American economists were all urging, weaker responses to the financial crisis of 2008 than were warranted by the disastrous facts. Anyway, so toward the end of that two-day seminar, in the final hour, we had grad students and young assistant professors actually begin crying. I am not making this up, saying that they couldn't say these sorts of things in economics. They couldn't publish them, and it would just cost them their careers if they did that. Now, that was one experience. There were some others. Folks would show me rejection letters from economic journals. One editor of a well thought of journal actually wrote this person, this is a really interesting paper, but since it doesn't have a representative agent model, we're rejecting it. Punk, end of story. And yet another person showed me a paper where he had taken some hundreds of economists doing one European country. And he had sort of shown that there was a whole network of institutional affiliations, even some political significantly ones. And he'd submitted it to a very well-known journal. And the editors came back with that, well, you know what, this is just one country, so it couldn't happen in the rest of economics. Now, that's a little bit too blockheaded almost to be allowable, since they were, these were European economists trying to get into predominantly Anglo-Saxon journals. And that was immediately obvious if anybody bothered to read carefully. And so that, these were, if you like, negative facts. Positive things, though, came from, we launched at INET a project on citations and the structure of economics. Jim Heckman did a paper which was, attracted a lot of attention for its comments on the structure of journals. There being, it looks a little bit like the old car industry before the Japanese arrived in the US or something like that. But in other words, a shared monopoly. But one of the less noticed parts of that paper was the observation that books actually had more influence than economics than most people recognize. It wasn't just a journal article story after all anyway. So it seemed like it was sensible for INET to try to do something to make sure people can get published. with actual new economic thinking. Now, there's a lot of fake stuff out there these days. I mean, it's fun to watch people I've sort of known for 30 and 40 years opposing everything that I would have thought was sort of reasonable economics or politics, sort of try to imitate. But the biggest and most popular canard now is that big data will cure your problems. Now, for sure, data is a serious problem. And Lance and Özlem's book has plenty of data. But it's also the case that you have to have questions and to approach them with something in your brain that isn't simply recycled from 30 years ago. I sort of threw up my hands after one conference where I heard somebody say, what are we going to do in the wake of 2008, when they said what we'll try to do is persuade older, richer people to throw more parties. They derived that from an economic model. Well, okay, at that point, we are now in Alice in Wonderland. So we think, therefore, there's a very good reason to have this series. And we will have a string of books coming. The pipeline is actually fairly full. One is through all the acceptances, so we can mention Ed Kane's work, title called Banking on Bull, and you perhaps can imagine, if you know his work on central banks, where that might be going. But today it's Lance and Özlem's study, so I'll just turn it over to them. The way this is going to run, we hope, waiting for the inevitable electronic failure or a meteor hit or a wildfire or something. This is, after all, the age of COVID. They'll speak each for about 8 minutes or so, and then Pia and Duncan will respond for 8 minutes, and then we'll ask Lance and Özlem to respond again. I might make a few remarks, but that's basically the story, and then we will take questions from the audience. So there you have it. Lance, it's all yours now.
Okay, but I can't see the pictures.
Yes, but we hope it's in your brain.
All right. Well, I'll try to yell because my computer mic is not working terribly well, it seems. But I would like to start with the first slide. Could you put that up, Claire?
It's up.
It's up. Why can't I see it? Why do I see Zoom?
Trust me, it's up.
What?
It's up.
It's up, but why can't I see it? Well, okay. It would be good to see it. But in any case, what the first slide shows is a striking break in the share of wages in GDP. That is, for a long time, beginning in 1929 until around 1970, the share of wages in total output was roughly stable, was roughly constant. That used to be known as Bowley's Law, but then it all of a sudden ended around 1970, 75, and you see a very strong downward trend in that picture. That is a clear break and is sort of the most important empirical finding that we have. That is wage repression, beginning along about 1970, just before Reagan, and continuing into the era of Trump. Now, if you go to the next slide, which I still can't see, you see that other components of income
Okay, Lance is up in Maine, and he appears to have fallen off briefly. My suggestion is that Özlem, you just take over, and if we can get him back on, we'll get him back on.
Okay, so Lance was going to talk about this wage repression that has been beginning since the mid-1975 and continuing so on. And then he was going to talk about how this wage share decline also shows itself as a increase in profit-like so-called proprietors' income and rental income of persons and the corporate profits tax after taxes. as you can see, the same dynamic continues for those profit-like incomes, which are actually accrued to top 1% of the income distribution. So he's probably going to go into more detail, showing that how these two class simplified SEM is showing those differences. So here Lance is basically trying to respond to Piketty's argument of R being greater than G, which is a growth rate. As you can see, while the gross domestic business investment to business capital has been quite stagnating after the quite stagnating through the process. On the other hand, profit rates, which is the total profits or gross operating surplus to business capital, being increasing. So coming from this side of the story, that it is not just accounting identity, it is not the argument of R being greater than G, but this is basically the structural situation in the economy. And he was going to talk about how, since we are having this functional distribution, inequality in the functional distribution, we see all those profit shares increasing through the period because wage share was declining at the same time. And our argument is basically that this savings of the businesses actually accrued to top 1% of the income distribution through the financial transfers and holding of losses, which is the capital gains for the top 1%. As you can see from this plot, it has been increasing throughout the period. So this is why holdings, capital gains are being larger than the net business saving. Also shows that this was the point of how they accrued to the top 1%. And then again, as a capitalization ratio, which is Tobin's Q always has been bringing in to the picture when we talk about how the capital gains have been created in the economy. We are seeing the Tobin's Q picking up through the process from 0.5 to 2.5 throughout the process. But what we call the realization here, the R over J, which is the net profit rate divided by long-term interest rates, which is the capitalization of the financial markets. And here we see that this jump was explaining and accruing mostly in the capitalization. I'm sure he will come back and make his points. This was just a brief conclusion from his part. But again, as this profit rates, real profit rates, especially after the 80s, and has been with the policy side, Greenspan era and follow-up, pushed down through the time, and wage depression on the other hand, coming from the production side, obviously increase that effect of increasing profits in the markets, which is also caused asset price inflation, which Lance has been talking in the book. So overall, what we see is all those profit increases to increases and inequality, functional inequality increasing. And my turn is basically to talk about how this functional income inequality actually channels into the size distribution and what is the role of sectors in the U.S. economy. So this big we will start with the Palmer ratios, which is here measures the, of course, income inequality, for the US. It is probably better than Gini coefficient because it's not as sensitive. It is more sensitive to the extreme part of the income distribution. So as we can see from the beginning of the period, income, the comparison between the top 1% of households and the bottom two class has been increasing steadily around 3% over the period. This is quite a big jump for macro ratio, let's say. And this is for the based on disposable income, and the trend is obvious. In order to understand how those profits created in the market and channeled to the size distribution, it's also important to understand, of course, the sources and uses of different income classes in the economy. Here we are looking at the average real income of top 1%. On the left, you are looking at the sources. As you can see, biggest chunk of their income has been coming from the labor compensation, which is mostly bonuses and the stock options were created in the financial markets and as a gift to those people. And also they have a high level of proprietors income, interest and dividends, and capital gains, which is created through the asset inflation. And they hold around 70% of total capital gains. And another striking point, it has been their income has been increasing throughout the period. And when we look at their uses, obviously they have consumption and taxes, but more striking that they have been their savings has been increasing throughout the period, which is important because it adds up, adding up in their wealth in the long run. The picture for the middle class has been quite different for the middle class. As you can see, they have around 180K per year on average in the end of the period. Most of their income comes from labor compensation, and they have some visible capital gains, as you can see, but their income has been stagnating over the period. And on the consumption side, user side, big part of their income, of course, goes to consumption, and they were quite highly hit by the taxes. But their savings small, but have a visible appearance. And finally, for the bottom 60% of the households, their income mostly coming from transfer incomes and labor compensation, and it has been increasing throughout the process. But it's because due to the transfer increases in their income. But when we look at their uses, they have been consuming more than what they make, so their savings are negative throughout the period. So we can say that those increases in both bottom class of the incomes and the upper class top 1% income increase basically cause a huge squeeze in the middle in the middle class. So next we try to analyze the 16 sectors in the US economy between 1990 and 2016. Here we are looking at wage growth versus productivity growth of those sectors. There are some striking points to make. First of all, on the left corner, as you can see, this part is basically what we call stagnant sectors, and they include construction, accommodation, food and services, and health, entertainment, and transport sectors. And they have really slow or negative wage and productivity growth. And on the right-hand side, you are looking at the dynamic sectors, what we call, and they include sectors like manufacturing, utilities, information, and finance. So besides being different in characteristics, they share one common point, which Lance was supposed to talk about in detail, but we can come back to it after through these slides, is the wage retardation in those both of those clusters. When we look at the trend line, basically, both trend lines has a cross-sectional elasticities around 0.6, 0.65, saying that wages have been lagging behind the productivity throughout the process. In order to see how this structural duality, we call, affected the employment, the macroeconomic variables such as employment share, profit share, and the productivity growth, we first focus on the employment share growth with a decomposition, we call. What we did is basically we weighted the sectoral productivity and demand growth for each sector to get the overall impact, to see the overall impact of those sectors in the overall employment rate growth. As you can see, the duality actually shows itself, again, the same as in the previous lecture. When you look at the right, you are seeing the stagnant sectors, which includes education, construction, and entertainment. Those are the sectors with a increasing demand growth and stagnant productivity growth, which means they have been the driver of the overall employment share increase in the overall economy, because as we know, demand growth has a positive impact on the employment share, while it was the opposite for the productivity growth. So on the left side, they're basically the dynamic sectors that has higher demand growth, high positive demand growth, but their productivity growth has been so higher than the demand growth, so the impact actually outstripped, and those dynamic sectors unfortunately lost a lot of jobs. So this tells us that obviously there is a shift from dynamic sectors to stagnant sectors in a sense that all the jobs, or some part of it, lost in the dynamic sectors are observed by the productivity growth. And this is the overall impacts of each sector. As you can see, main drivers of the job increases in the economy is coming from education, health, business sectors, accommodation, and food, which are the stagnants. And on the right, biggest job losses are from the manufacturing sector. And finally, again, in the first part, what we were going to try to talk about was how the profit share has been created, how profits have been created, and then given to the top, the size distribution. Here is the basic kitchen of that process. We are again using the similar idea of decomposition. Here we are basically decomposing the profit share based on weighted average of wage increases, productivity shifts, and demand shifts. And as we all know, wage increases have a negative impact on profits, while productivity effects and demand shift has positive. If you look from the bottom, again, this is the contribution of each sector, or how much each sector actually holds, how much profit they hold. The biggest part, basically, again, when you go from bottom to up, upper levels, we see manufacturing, wholesale, retail, which are the dynamic sectors. They have higher productivity growth and some impact, positive impact from the demand shift, even though they have increasing wages. Overall outcome is still they hold most of the profit share growth in the economy. On the other side, in the minor side, it's basically when we look at the construction, for example, they lost, they suffered from increases in the decline in their demands and decline in profit productivity shift, of course, but they actually utilized from the wage declines in that sector. And another visible one is the business service sector. They have been paying higher wages to the comparing to the other stagnant sectors, but they of course have also the productivity higher, so their overall profit share has been declining. So why is it important to look at how these changes or structural shifts in the economy affects the overall picture, where it comes from, in a sense? We see that if we look at all those, if this wage retardation that we have been talking in the book keep continuing, we will have probably deepening stagnant sector structure in the economy, and overall they are not only gonna affect the declining wage share even further down, they are also gonna bring the productivity increase or slow down to the picture, because as we can see, once those sectors take over, and since their productivity growth are really slow or negative, they're going to start bringing the economy to the slower productivity growth. Besides that, once this movement in the economy happens, the most affected part of the economy is going to be, especially from this shift to stagnant sector, are going to be the bottom class of the income distribution, and they are going to keep getting less and less wages overall. So this was basically the idea of, sorry, 1 second. The idea of the book was basically to talk about how this structural change in the overall economy created a dynamo to increase the profits, and how these profits are created is basically increasing asset prices, low interest rates, and of course suppressed wages. And this is just structural, even though some other part of the economic structure, such as monopoly or fishing or superstar firms, have an effect. When you look at the bigger picture, they basically have the same dynamic behind them, which is wage repression. So thank you. This was a quick one.
All right, thank you, Özlem. Lance, now we missed you. Perhaps, I mean, it was very clear in Özlem's presentation, in your graphs, the dual character of the economy with that mix of low productivity rates and low wages. And it was very clear about the drop in wages over time. Could you perhaps elaborate on a few points in between, just for a few minutes before we turn it over to the respondents? Say, if you can do it in 3 or 4, I think everybody would be grateful.
Okay.
Lance here, I think. Lance?
Yes, I'm here. Can you hear me?
Just barely.
I've lost you again.
Well, I can see you. All right. Then look, let's do this. Let's move to the respondents who have, after all, read the book. And then we'll try to get you back in toward the end of there. I mean, you'll get a chance to comment on them. And in the process, some of these comments, notably your critique of Piketty's work and some conventional approaches to why inequality has increased, say like the tremendous increase in a monopolized information sector, you know, you could maybe bring out some of these points. They're among the most interesting in the book. We go first to Pia.
Okay. Thank you, Tom, and thank you, Lance and Özlem. This is a critical piece of work, especially given where we are. In a year when the United States faces more upheaval and dissatisfaction than at any time in the last half century, many are asking, given the heterogeneous manifestations, if there is any simple explanation for the various simultaneous breakdowns. While a consensus is still to form, the simplest explanation could well be that what we are seeing is the downstream effects of inequality, perceived through the lens of injustice and political economy. We can ask how the American worker fell so far below the American CEO, hedge fund manager, venture capitalist over 2 generations during the period of neoliberalism from 1980 to 2020.
Yeah,
The key
hi,
question that you have raised, sorry?
Just go ahead.
Okay. The key question that you have raised with this book is, did this worker indeed fall or were they pushed? In the description that has become standard in many sectors of economic research, a list of inexorable forces is offered up, which has created the concentration of wealth amongst the 1%. Financialization, immigration, globalization, automation, casualization, stimulus, and the need for competitiveness and efficiency are frequently cited as exogenous forces that have affected the bargaining power of the American worker. Any one of these much discussed trends can be invoked by economists as if one was discussing earthquakes and volcano eruptions, which arrive somewhat at random and which must be accepted as there is nothing one can do to stop or even predict their arrivals. But is that really the case? It's been said that the idealism of every age is usually the cover story for a theft. In the 1980s, the cover story under which organized labor was dealt a huge blow was competitiveness and deregulation, and the need for labor concessions and the removal of red tape. By the 1990s, the story had shifted to globalization as manufacturing moved overseas and corporations competed to talk about the wonders of inviting all the world to participate and share in the American miracle. By the 2000s, the ostensible idealism of universal home ownership and the great moderation allowed for the financialization of the enormous real estate sector. That is until 2008, where stimulus, relief, and rescue operations transferred vast amount of wealth among those whose actions had caused a crisis, while those on the hook for involuntary non-recourse loans looked helplessly on from the sidelines. By 2011 or so, equity and identity issues came to the fore, which initially substituted symbolic gains for marginalized groups at a cost far below that which would have been required for economic gains. But at each turn in this neoliberal arc, every time the worker appeared poised to exert any pressure at the bargaining table relative to workers, an ugly story appeared in the national dialogue. Unions were obstructing the right to work. Calls for assistance for workers were labeled as welfare, when assistance to capital and management were termed relief. Gains by workers were termed wage pressure, which threatened the specter of runaway inflation, requiring interference by central bankers. Any attempt to control the pushing out of the labor supply curve through immigration was referred to as xenophobia. Attempts to normalize taxes on business entities, carried interests, and capital gains were seen as too dangerous to attempt due to the flight risk of capital and the danger to fragile company profits. In Lance and Özlem's retelling of the tale, however, the earthquakes and the eruptions that have held so many wages stagnant for half a century are actually not forces of nature, but of political economy. This alternate explanation of the phenomena of stagnant wages beginning in the early 1970s can be seen more clearly as wage repression. In fact, were any of the above-mentioned forces truly exogenous, they would not have needed lengthy campaigns meant to explain seemingly regressive changes to the legal and financial structure of the United States. As Brad DeLong recently put it at an INET conference, the welfare function being optimized by trade agreements like NAFTA is intrinsically social Darwinist, as even in theory, it scales its rewards with the cube of one's wealth. At any time, a government committed more to the majority of its citizens than its political donor classes can choose to put more pressure on companies by disincentivizing offshoring, immigration flooding, casualization, and tax shifting schemes. In this framework, then, globalization is not an exogenous factor, but rather an endogenous one, fundamentally determined by the political economy of the nation. The one place where I think this argument is less likely to hold, perhaps, is with the issue of automation. While robots may be the latest media fad, the statistic mentioned in the book that 5 to 10% of US jobs are in danger of automation doesn't fit with other estimates in the literature on automation and the future of work. For example, researchers at Ball State University estimated nearly 88% of the decline in manufacturing jobs between 2000 and 2010 can be attributed to automation. While the manufacturing sector may only employ 8% of the workforce, it's not just manufacturing jobs that are threatened. Over the next decade or two, Fry and Osborne predict that 47% of US jobs could be automated. A study by the McKinsey Global Institute on the Future of Work finds that about half the activities people are paid to do in the global economy have the potential to be automated by adapting currently demonstrated technology. While less than 5% of all occupations can be automated entirely, about 60% of occupations have a huge component of their constituent activities that could be automated. One of the difficulties with modern computing and automation is that many technologies exist in a prototype state for a period of time before suddenly becoming mature. Web commerce, smartphones, video conferencing, and facial recognition were all examples of technologies that even a short time ago were too clunky and expensive to seem transformational. When this pattern is applied to the technologies of today, however, the potential impact seems enormous. GPT-3, self-driving vehicles, distributed computing, CRISPR are all still new to us, but they threaten to replace humans in areas as diverse as journalism, government, government, trucking, and even reproduction. In short, the next technologies to make the jump to commercial viability are already in prototype phases that allow us to anticipate the level of impact, nothing short of a singularity in the future of work. I believe, therefore, it's critical for us to be looking at this area if we really are going to be thinking about wages over the long term and the compounding of wages and actually making sure that we have returns to wages as opposed to profits. We need to be thinking about this either in terms of Richard Freeman's framework of who owns the robots, or Danny Roderick's idea of industrial policy that actually allows us to shift profit sharing towards workers. But I do believe that the next frontier is going to be the changing technologies that are going to adapt, are going to change the future of work. And we need to think about how we actually adapt this idea of the compounding nature that you talk about in your book to thinking about how we distribute future profits towards, so that a greater percentage goes towards labor. Thanks. Duncan, I can hand it over to you now.
Yeah, thank you, Pia. It's Duncan, you're up. And then let's have Lance respond at a little bit more length than 4 minutes if he wants to try to fill in what he wasn't able to earlier.
Sure. Well, thanks to INET, Rob Johnson and Tom for getting this book launched together, and congratulations to Özlem and Lance on this book, which I think is a very important book and deserves a lot of attention. And I'll try to explain in the few minutes I have some of my reasons for thinking that. I have just like this, take a tiny minute on a personal note that I've had the privilege and pleasure of working with Lance and Özlem over several years at the New School. And I just want to say how much I've learned from that and how much I still feel that I have to learn in the future from that, and look forward to ongoing interchange of ideas and critical thinking, which has been a very positive part of my intellectual life over this period. So why is this an important book? Well, I hope who reads this book are actually the left wing of the Democratic Party and other people who think of themselves as a progressive political force. Because I think this book, which is, as Tom mentioned and Pia mentioned, and as we saw from Özlem's presentation, which is very solidly based in empirical data. This book actually has some messages that I think need to be heard as a correction to certain wishful thinking on the part of the progressive left. So what are these important lessons? Well, first of all, there's the question, everybody, I think it's fairly widely acknowledged that inequality is, and Pia made this point very effectively, is at the root of a huge range of social and political issues in the United States. And then if you believe that, then you want to understand why has there been this inequality and what is the pattern of its growth? Well, this book tells you two things that are extremely important. One is that the ultimate source of this inequality is wage repression. And that's a key point, and I think has to be put in the center of any political economic effort to address this. The second is we didn't get into this problem yesterday. If you look at those graphs, they go back to 1970. So we're talking about 40 or 50 years of gradual and cumulative impact, which has led to the tremendously increased skew in the income and wealth distribution that Özlem and Lance document as part of their story. So that means it's certain, and actually taxation does not have a big role in this. One of the easiest and quickest things that a political process could do is to change tax rates. But Özlem and Lance's work suggests that that's only scratching the surface. It may be a very important thing to do to get tax burdens back in some kind of proportion to ability to pay. But their work suggests to me that that's only the beginning of the problem, and that deeper reforms have got to touch this problem of the problems of wage repression and the sources of wage repression, and they have to be long-term, and so that they can be sustained for a long period, and that we cannot expect to have, next year or the year after to see the full implication of successful policies. It's in that light that I would see Pia's theme of robotization or mechanization of work. Because if you find some successful way to push the wage share up, that's going to mean pushing wages up. And one of the defensive moves of employers in the face of rising wages is mechanization, automation, and robotization. So you're pushing this, you're going to be pushing the wage share stone uphill on that ground. I think those are the main points. Maybe I just want to say a little bit about the whole issue of causation and in social science, because that underlies it. Since the reason we want to know the causes of things is because you want to get some handle on what to do about them. So if you are concerned about inequality and the various implications of inequality, you'd like to know what could be done about it, and that's a causal question. Causality in social science is immensely difficult to untangle because societies are complex systems with huge numbers of positive and negative feedbacks that make tracing linear causality very difficult. The model of knocking over a pile of dominoes where one domino knocks over the next one is just not a good image for this kind of causation. A much better image, in my view, is a web, that you have a web. And what I find very convincing about Lance and Özlem's book is their identification of some central points in that web. In particular, that wage repression is one of the central points, or probably the most important central point in that web. And therefore, if you want to get some leverage, you're going to have to do something about wage repression, whether it means strengthening unions, strengthening minimum wage laws, improving the bargaining power of workers, or in my view, the most important single thing one can do is to run the economy at a much lower, much tighter labor market with much lower unemployment rate, and therefore try to create much higher pressure on money wages. That's been something that I'm afraid that the Democratic Party as a whole has been extremely reluctant to embrace over this long period that the book reviews and covers. So I'll stop there and see what Lance has to say, and I hope he speaks up so we hear every syllable. And just thanks again to Özlem and Lance. Oh, I was going to say, this is a really lucky book for INET to have at the beginning of their series, because it's such a terrific book. It's going to be a very hard act to follow, though. So I have some sympathy for the other authors in the queue that they have a very high bar to come up to.
All right. Thank you, Duncan. And yeah, Lance, suppose you take most of the reply time with Özlem also coming in. I would comment on Duncan's last point. Yes, this is a very difficult act to follow. But the second book I have read, and it is stupendous. It's Ed Kane's. Just watch. The view here is don't believe and we'll all be saved. It's that it's going to happen. Okay, so Lance, you're up. You need to unmute yourself.
Now, do you hear me now?
Yes.
Okay, I'll try to speak loudly. And I'm sorry that for this glitch, which I probably caused myself by fiddling with the computer. But in any case, let me try to respond to some of the comments. The first point really follows from what Duncan was saying, that in all the social sciences, you're dealing with overdetermined situations. And one has to try to look at sort of key linkages, but realizing that you're going to leave quite a bit out. I agree that wage repression, Özlem and I have been thinking for many years now, or several years, that wage repression is a key issue. And it's also a slow change in the system. That is, real wages, or the wage share rather of output, will tend to go down when real wage growth is less than productivity growth. Now that difference has been fairly small, sort of 0.4% per year for 50 years. It took 50 years for the sort of distribution to shift as far as it has away from wages and toward profits. So recovering from that sort of situation will take a long time unless wages really grow, real wages grow really faster than productivity. And that may or may not be likely, particularly in light of some of the issues that Pia was raising. So let's take the first point. Wage repression is the key factor, and one has to try to work out the implications. Now, one implication is that there's been a substantial increase in the profit share and an increase in the profit rate. That leads to the sort of Piketty diagnosis of rising inequality. If you look at the data in the SAM, which I won't bother to bring it up again, but total investment in the economy is something on the order of $3 trillion in that social accounting matrix. Total profits are on the order of 20 trillion, even corporate profits. So there's a big, there's built into the data, there's a large differential between profit rates and investment, between the profit share and the investment share. And that's, as an accounting identity then, you have to have saving from profits being less than 1. And in the R greater than G inequality, saving from profits times profits has got to equal G. Saving rate is below 1, so profit rates have to exceed G. I mean, it's just an accounting identity. which is built into the data in most countries, all countries, and is not going to go away. So that in that sense, the R greater than G is a red herring and doesn't really explain what's going on. But going back to wage repression, that has several implications, which I think are important to follow through. If real wages are growing less rapidly than productivity, that means that money wages, or the growth rate of money wages, is less than the growth rate of prices plus productivity. The reason why interest rates, recall that Özlem was pointing out that Tobin's Q, or basically the asset prices, are basically the ratio of profits to a real interest rate. Real interest rate has been low ever since Alan Greenspan took over at the central bank in the mid-1980s. Real interest rates have been held down to boost up asset prices. But if real interest rates are held down only because inflation has been slow, inflation has been slow because money wage increases have been slow. And so in effect, if you want to go into the issues faced by the Fed and trying to hit its targets on inflation, it won't happen. It cannot happen unless there's an increase in money wage pressure, which would lead to inflationary pressure, which would lead interest rates to go up, which would force down asset prices. So the Fed itself and that side of the macroeconomy are caught up in a sort of situation, in a catch-22 situation. If they do one thing, it will have one effect. If they try to do the other thing, it will have another adverse effect. And that's a problem of macroeconomics that's built into the existing situation. On the issues raised by Duncan and to an extent Pia, it seems to me that underlying the increase in inequality over the last 40 or 50 years, obviously there have been microeconomic factors. To my mind, the most important factors microeconomically have taken the form of fissuring of labor markets, the politicization of the National Labor Relations Board, a whole series of institutional changes which have had the effect of forcing down bargaining power on the part of labor. As far as globalization and goes, I mean, if you look at the sectors that Özlem was showing, there are only 4 or 5 sectors in the economy that are strongly open to international trade. That is finance, manufacturing, a certain amount of agriculture. You're talking about a relatively small part which is directly affected by foreign trade, which means that again you have to look at internal causes for a good deal of the wage repression. I just had a sign coming up on my screen saying your internet connection is unstable, which it is, living up here in Maine. And I hope that it's not completely upsetting what I'm trying to say. Those would be the main points I have in mind, I think. And I think we should probably turn it over to discussion.
If you'd like to add something, you're welcome to. Otherwise, we can indeed go.
Hello?
Özlem, can you hear?
Okay, now I hear you.
Yeah.
So thank you, Duncan and Pia. Those are the great points, and I'll start to respond with the Pia's part. Obviously, this problem that we are facing are more of a political economy problem, other than just some trivial changes in the structure, the historical structure. So basically, if those technological change keeps improving and going on, we shouldn't forget that what we are trying to say, the cost of production is mainly coming still from wage costs. So if this wage retardation we are talking about is keep going on, this is gonna affect mostly to those stagnant sectors, and they're gonna probably lost all those jobs, but this circulation can move back and forth between dynamic sectors and stagnant sectors, and bringing down the productivity growth and the wage repression even further down. But overall, I would expect still some loss in the like 8 to 10%, as you said. And about the Duncan, I agree with Lance. More extreme measure has to be taken to prevent those structural change.
Okay, thank you very much. Now we have some questions from the audience, and I think I won't use people's names, but we have one question coming in. It was suggested this would show that monopoly power was not a major factor, but isn't market concentration a driver of a lot of these trends? Weak bargaining power due to lack of job alternatives, low rents, etc. Lance and Özlem, why don't Lance go first? And Özlem, you can also obviously comment. It's not like this needs to be strictly regulated, like going through a red-green traffic light.
Lance, please go. You should, yeah.
What?
You can go first, Lance.
I can go first. Okay, thank you. It seems to me that monopoly power, well, we're talking about a situation on both sides of the market between enterprise and labor, between business and labor, and both deploy some power. If you look at, for example, the big technology sectors, you're obviously talking about some degree of monopoly, a great degree of monopoly in the Silicon Valley companies. But technology is only about 5 to 10% of the economy, and that leaves a lot of situations in which monopoly power, in that extreme sense, is likely to be important. What you do see, on the other hand, is that most poor people, or most not high-income people, are in sectors. Retail, for example, is more than Amazon. Education and health, a big employer, but fairly not completely monopolized. You have a situation where both monopoly and monopsony power by enterprise matters, but also institutions have been so biased against labor that that's probably less important.
I think that's about the answer. Again, as I said, it's more structural than just the monopoly power and the concentration. Of course, they have a huge effect, but still, behind the curtain, the main driver is the wage repression, I would say, on top of Lance's comment.
Yeah, thank you. Could I just quick comment here? I mean, one hears the monopoly story all the time. But in the book, you folks make the point that that sector is just not big enough to tip the whole income distribution in the way it would have to do, which I think is actually very compelling there. The other point that one wants, I think, to make in this context is that there's a lot of talk, for example, about restrictive labor agreements, which could be treated as a form of monopolization. But in truth, that the ability of that kind of an agreement to work depends in no small part on things like the state of aggregate demand and the institutional pressures that are very general on wages. I mean, in other words, you can get people to sign agreements that if you are fired from McDonald's, you can't go work for Burger King. Those won't hold in a tight economy, and probably no attorney general, even the ones we now have, nourished by both Republican and Democratic contributions from each party's respective 527s for state attorneys general, they're not going to prosecute that stuff. In other words, the monopolization story probably, I think you're exactly right, that works only so far, but it's quite, I think, well overstated. In that. Could I ask, we have a question about in the national account, this is a more technical question. In the national accounts, proprietor's income, mixed income, is part of net operating surplus. In your calculation, is mixed income calculated as part of the wage share, profit-like share, or divided by both? And what's the rationale for the way you do it?
Proprietor's income is not part of profits. Is not part of the wage share is typically measured. The wage share that we're working with is essentially wages that are actually paid to people and supplementary income, that is contributions to retirements and healthcare and that kind of thing. That's the wage concept that we're using, and that's the share of GDP that has gone down by about 8 percentage points over 50 years. And the non-wage component, non-wage component includes proprietor's income. But the main contribution to non-wage income is corporate profits, and proprietor's income is another contributing factor.
Yeah, I think their question was about as part of operating surplus, which
It's
appeared, yeah, which appeared at one point in one of the graph, in one of your figures. We are technically over time, but we can run a few more minutes. Could we perhaps ask you each to sort of, that is Lance and Özlem, you've worked on the US. Özlem obviously is very familiar, but I know Lance is too with other countries. Yeah, could you make a few remarks on how your analysis would play out, say in Western Europe or in other countries? Just what would you think is the big distinctiveness of the US in this?
Lance, do you want to go first, or?
Well, it seems to me that the US is at the extreme end of the rich country experience in the sense of having a really ragged social net. If you go back to the social accounting matrix, for example, transfers from government to households is around 10% of GDP. In Western European countries, it's far higher. And the safety net and the sort of institutional basis to support relatively low income is much stronger in Western Europe than it is in the US. If you were to compare the US to say a country, we can talk about Turkey or Brazil or something like that, the difference there, I think, is a more developed market structure here and greater state intervention and greater ability to withstand outside pressures. Country like Turkey, for example, is wide open to outside pressure because of extreme dependence on capital inflows. That's simply not true here. The macro situation differs across countries, and one has to try to take that into account. And depending on degree of similarities, you'll get different responses.
Yeah, I think on top of what Lance said, I think the situation differs between developed and developing countries. For example, developing countries, we can still see, in Turkey, for example, you can still see that pattern of growth, productivity growth being higher than wage growth being higher than the productivity growth. But again, the institutional pressure also is in that developed world, and they are more like a Lewis, following the Lewis's argument when it gets to the developed level. But I think at one way or another, most of the countries are going to go through the same cycle. And for different European countries, I think they have extreme cases just like the US as well, even though, yeah, it might be different in terms of institutional background.
Okay, could I just ask you both to react to one other thing on globalization, the points that have come up before, which is, it is striking to me that as you look at how the Federal Reserve has responded in this crisis, it is perfectly obvious that that's having fairly dramatic effects on income. Lance has indeed been writing about that for us at the time, even before the CARES Act was published. It's right on our website. They're very good analysis. And the striking thing to me is it would be very hard to see any very much in the way of any direct globalization pressures that are making the rich so much richer right now. I mean, this is a policy inside the United States. You could do things differently, and it's not really practical to claim that, say, the Fed had to do the way they did it and what they did, you know, the failure of the Main Street program, which Lance correctly predicted, right, as the CARES Act passed, wouldn't work. There's nothing in the logic of globalization that says that has to happen. But you are looking at really major and dramatic changes in the US income distribution, and I think also in the industrial structure. It's just, I'd be curious how you react to that.
Well, certainly globalization has had effects on the manufacturing sector. There's no doubt whatsoever about that. But compared to, say, the financial pressures or the financial sector to which the Fed largely responds, that's much more important internally, and I think is likely to be the more important driving force. Just to pick up one thread that we had in the presentation, the capital gains have played a very important role, played a very significant role in raising the incomes of the top group of households, as you saw in the slides that Özlem presented. Now, those capital gains, for example, if you were to, they could be taxed at a fairly high rate, and that could be used for social purposes, or even for creation of a wealth fund like CalPERS to try to offset some of the power of the holders of asset of the top 1% that holds sort of the big component of stock of shares. Those sorts of interventions are certainly possible in practice, in theory, but whether they can be carried out in practice is another question altogether.
Özlem?
Globalization actually plays a big role in overall structural movements. And what to do is basically to protect the bottom class, the workers, basically, like increasing their bargaining powers, so then they can actually try to keep or hold the jobs here in that sense. And yeah, as Lance said, manufacturing is one of the ones that will be affected from that side of the story.
Look, we have several questions about inflation.
I can't hear.
Okay, we have several questions about inflation. I'm going to have to group them together in order to give you something you can answer in the time left to us. Could you talk a bit? I mean, when everybody hears the phrases about increasing workers' bargaining power, the thought that flashes through many, many minds is, oh, this will lead to inflation. It's as though the whole world, and certainly the whole press that writes about it, we're all thinking like central bankers. Could you talk a bit about the relationship between, okay, suppose you got better bargaining power for workers in the United States and you raised wages. What then happens to inflation in your view, and why?
Well, there's a whole literature on structuralist inflation theory, which is not even recognized in the US. And the basic point is that when workers' bargaining power goes up, there is likely to be upward pressure on prices. Depending on how much firms are willing to absorb of that pressure and how much they're not willing to absorb, you probably will get more inflation. You would have a higher, you basically have a significant, you could have significant cost push, which could lead to faster inflation. And I think really the world is going to have to deal with that if the wage repression comes to an end. The last inflationary period in the US in the stagflation decades of the 1970s to a large extent was driven by oil price, by raw material price increases, including oil price increases, but there was also wage pressure. And different countries, in my experience, have different inflation thresholds. What would be 5% here in the US would probably be considered disastrous. What is it now in Turkey, Özlem? Something like 15 or 20?
Yeah, that's what they say, but it's more than that probably.
So,
Yeah.
so you know, different countries respond to that differently, and the U.S. has a fairly strong anti-inflationary bias, which is another reason why austerity is pursued so aggressively here as opposed to some other places.
It's not surprising that financial centers have a bias toward low inflation, though, I think.
Yeah, they like low inflation and strong exchange rates.
Anyone else on the panel want to make any final comments? Duncan, Pia? All right, well then look.
Yeah, there was one question in the question and answer that I did try to answer, which was what would be the most effective policy to fight wage repression? I just like to repeat what I said. The most effective policy to fight wage repression would be to run aggregate demand policies so that you had a sustained, very tight labor market. And we saw that happen. We've seen that happen only a very few years in the last couple of decades. One was at the very end of the second Clinton term, and the other was actually just before the COVID epidemic struck, when we had sustained, we were getting to very sustained low unemployment. But you know, you're going to have to change the whole political economy, the way people look at the national debt issue, and what the Fed thinks its role is to implement that.
All right, well, look, on that note, thank you all very much, the panel, for talking. Thanks to Cambridge University Press for helping us with our series. Thanks to INET, my colleagues in events and communications, for their help in publicizing this. And thank the rest of you for attending. I think there's another INET seminar next week on Tuesday with Mike Spence and some others around noon. You can look for the announcement if you like on our website. But thanks everybody for coming and talking.
Thank you.
Thank you.